John, you talk a lot about fixed income investing and credit analysis. Maybe you could give us an example of what that actually means and how you go about selecting investments for your portfolios.
Well, Mike, there's a lot of bonds out there, and every day bonds are traded. People buy and sell them. We look at bonds as if we're lending money forever. So if I'm going to lend you money for 10 years, I expect you to pay me the interest and the principal at maturity in 10 years, whether it's the government of Canada or a smaller company. So if anyone wants to have us invest in their company, be it debt or equity, and we do a lot more debt than equity, we assess the capacity of the company to repay us, the interest they owe us, and the principal at maturity. Now, in some cases, you see companies that can't possibly pay back their debt or even pay interest unless they issue more debt. To us, that's not a good investment. But on the other hand, there's lots of companies with strong financial capacity, very good underlying businesses that need to borrow money. So day by day, we look at these companies and decide which one to invest in. It's safe to say that we believe that the companies that are the cheapest, the overlooked issuers or the issuers that we think will improve and the market hasn't recognized the improvement, are the ones that we focus on. So if you're thinking of fashion, and investors are very fashionable, you can earn a lot of money by wearing a good looking suit and having nice haircuts in our business. If you look at investor fashion, you can see what is fully priced or overpriced. So anything to do with a Canadian bank right now is very expensive. Anything to do with a foreign bank is cheap. So we look at the credit capacity, the ability of the borrower to meet its commitment to us, and then we make those investments. So one of the best investments we've ever made is a company called Nortel. You might be familiar with, Mike, coming from Ottawa. Well, Nortel at the peak was 35% of the Canadian stock market. Everyone believed that they needed to own Nortel. If you actually looked at the underlying fundamentals, we thought the company was worth maybe $5 a share when it was $110 a share, but that wasn't a popular view. When things started to go wrong for the company, nobody wanted to own it. We watched it, but in bankruptcy, actually before Nortel went bankrupt, their bonds, which had been $100 as a single A issuer 5 years before, were trading at something like $16. We bought those bonds at $16 prior to bankruptcy, and after bankruptcy, and it went bankrupt in early 2009, so 4 years later, more than 4 years later, those bonds are now trading at $114. So you say to yourself, how before bankruptcy could a $100 bond be worth 16, and then after bankruptcy that bond be worth 114? Well, it's because the company itself still had cash flows, still had assets, and as they sold them off, the money went into the bank. Now, the judges are still arguing over who owns what, but Nortel currently has $114 per $100 of bonds sitting in the bank in cash. It sold off all its companies to other companies, all its assets, but its patents, which everyone thought were maybe worth $1 billion, ended up being worth $4 billion. So from our point of view, if you know what you're doing in the bond market, there's always something of value to buy.